A good strategy is not the same thing as a profitable outcome. And that gap is where most people bleed out. I think this is the first hard truth. If you keep losing with a good strategy, the strategy is usually not the problem by itself. The problem is execution quality, regime mismatch, cost drag, or a hidden assumption you never tested. In other words, the edge may be real on paper and still fail in your hands. That is not a motivational slogan. I start with the simplest failure. People confuse a positive expectancy with a guaranteed win rate. A strategy can be sound and still lose for long stretches because variance is not a side issue. It is the whole game. If your edge is modest, the distribution of outcomes will look ugly before it looks intelligent. That means you can be right in theory and wrong in the short run, sometimes for longer than your patience can tolerate. The danger is not the drawdown itself. The danger is that you react to the drawdown by abandoning the edge at the exact moment it is most likely to mean revert. But I do not let strategy off the hook that easily. A lot of good strategies are only good in a backtest, and backtests are where weak ideas go to wear a suit. The data is often overfit, the sample is too small, the assumptions are too clean, and the transaction costs are treated like decorative noise. If your edge disappears after slippage, fees, spread, latency, or real-world fills, then it was never a durable edge. It was a spreadsheet illusion. I care less about the beauty of the equity curve than about whether the logic survives friction. Then there is regime dependence, which is the quiet killer. A strategy can work in trending markets and fail in chop, or work in high volatility and die in compression, or work when liquidity is abundant and break when it is not. Most people do not build for regime shifts. They build for the last environment that rewarded them. That is a serious mistake. A strategy with no regime filter is not robust. It is exposed. The market does not owe your method a stable backdrop. And if the edge only exists in one narrow weather pattern, the edge is fragile by definition. Execution is where many supposedly good strategies go to die in slow motion. I see this constantly. The signal is fine, but the entry is late. The exit is emotional. The sizing is inconsistent. And the stop logic is violated the moment pain arrives. That is not a strategy failure in the abstract. That is a process failure. A strategy lives or dies through repeated execution. And repeated execution is where human behavior leaks into the numbers. If you widen stops when you are scared and cut winners when you are bored, you are not trading the strategy anymore. Position sizing is another place where people sabotage themselves while blaming the model. A strategy with a real edge can still fail if the sizing is too aggressive, because the math of compounding punishes large drawdowns brutally. Once you lose enough capital, your recovery burden rises faster than your remaining edge can support. This is why "I was right on the idea" means very little if the risk was miscalibrated. A strategy that survives only at tiny size may still be useful, but that is a different claim from being scalable. Scale changes the game. Liquidity, impact, and emotional pressure all get worse. There is also a more uncomfortable issue. Many people do not actually have an edge. They have a narrative. They can explain the strategy beautifully, but explanation is not evidence. A real edge should show up across enough trades, enough time, and enough market conditions to survive scrutiny. If the sample is thin, the confidence is fake. If the logic is vague, the edge is probably accidental. I trust repeatable behavior more than elegant storytelling. The market is full of strategies that sound smart and fail because they were never tested against the right question. Does this still work when conditions stop flattering it? The hardest part is that losing does not always mean the strategy is bad, and winning does not always mean it is good. That is why I focus on evidence quality. I want to know whether the edge is persistent, whether the sample is broad enough, whether the costs are realistic, and whether the failure modes are survivable. A strategy with a small but durable edge can be worth more than a flashy one with unstable performance. The first may look boring. The second may look brilliant right before it breaks. So, if you keep losing with a good strategy, I would not rush to replace the strategy. I would audit the chain. Is the edge real after costs? Is the regime still favorable? Is the sizing too large? Is the execution faithful? Are you forcing a method into conditions it was never designed for? That is the real checklist. Most losses are not mysterious. They are the result of one weak link in a system that looked stronger than it was. The market is ruthless that way. It does not punish bad intentions. It punishes weak evidence, poor discipline, and fragile edges that were never durable enough to survive contact with reality.